Technology is now a key element of banking, much more so than it was in the past. In this episode of Risk Matters, our chairman Klaus Nogren and myself interview Michael Zerbs, a world-renowned technology expert from Canada. In this episode, we will start by talking about his involvement with Algorithmics, which was one of the first fintechs that ultimately got sold to IBM. And then he will share his insights with us as the former chief technology officer of a $1 trillion bank in Canada about what are the main technology trends within banking, and mainly what should banks be thinking about as they invest in technology. We think it'll be a very interesting episode for you. If you like this content, please give us a thumbs up and subscribe to the channel. Michael, thank you very much for joining us on Risk Matters. I think the first question should focus on entrepreneurship. And I would like a little bit for you to explain to our viewers about how you were one of the founders of Algorithmics, how you built that company, and then ultimately how you sold that to IBM.
Well, thank you, first of all, for inviting me to Risk Matters. I'm really delighted to be here, and I look forward to our conversation today. So, really appreciate the opportunity. Now to your question, I think in my career over the last 35 years, I was really fortunate to work for two amazing but very different organizations. Algorithmics, and I'll come to that in a moment, as you said, Ariane. And then, of course, Scotiabank for the last 11 years, where I recently retired as the head of technology operations and digital. And now to Algorithmics, it was in many ways Canada's first fintech, but the word fintech didn't exist at the time. So we started the business in the late 80s, and it was really based on a groundbreaking enterprise risk management framework and the technology to implement it, which helped chief risk officers and other senior executives to fully understand how risks interconnect and how tail risks should be viewed. It also gave opportunity to realize significant capital savings, which was, of course, part of the value proposition. So one of the professors back in university days that I studied with started a business, and I was one of the first employees. And in the end, 25 years later, the professor and founder had retired, and I'd managed the business for about 10 years. And we had representations in literally all financial centers around the world, and probably managed to have around 50 out of the top 100 financial institutions as clients. It was an amazing success story by the time we sold the business to IBM. Now, the question, of course, is how did you get there, and what turned a startup in an attic? It wasn't a basement; it was an attic. How do you turn a startup in an attic into a groundbreaking company that materially contributes to risk management? And I would say there were probably three key ingredients. And the first one was amazing talent. The original founder had an opportunity to bring talent in technology, but also in business, in professional services together, and unite us around a common mission. And the mission was to bring a new way of looking at enterprise risk, a scenario-based way to look at enterprise risk. And he excited us, and we did it, right? So that was the first thing, talent. Second thing, an idea that really was different from how risk was managed at the time. And the third, and Klaus, maybe this will resonate with you given your background, it was the right time in the market because Basel had just approved internal models, and the approach that we brought to market was the first industrial strength, production quality, internal models approach to capital management. And so there were also significant capital savings that could be realized. So it was the right time. It was a new idea. It was a clear value proposition, and it was strong talent that brought it all together. So I would say those were kind of the key ingredients.
No, that's Michael, very interesting. Having been kind of through the phase of the development of the Basel requirements, it was so evident that this opened up a whole new universe. It was like an n-dimensional diagram that you were put into. and to develop that. So I think that that's very interesting. But kind of just referring to that to today's world and today's technology, I think some sense the development of technology-related regulation has opened up a new n-dimensional diagram in the interplay between banks, consultants, and business and
Yeah.
regulators.
I think about that quite often because when we started algorithmics back in 1989, there was no unified approach to enterprise risk. The bond desk used duration and convexity. The option traders were excited and understood delta, gamma, theta, vega, and that was about all there was to it. And the equity test was maybe looking at price earnings ratios and things like that, where the stocks were over and undervalued. But there was no way to truly bring risks together, and that's what we solved for. Now, fast forwarding to technology risk, Klaus, to your point, I think we're kind of in the pre-unified days. We have ways to measure different technology risks. Is our software up to date? Are we patching frequently enough? How many outages do we have, and how fast do we respond to outages and things like that? But it's a long list of individual things that we're all trying to manage. Yet, I don't think we as an industry have had yet the chance to bring it together in a framework that you can consistently explain to yourselves as senior management, to the board, and to regulators and other stakeholders. So I often think back to how quickly the industry changed when I think about market risk, credit risk, liquidity risks, and the unifying approaches we took there over time. And I'm actually quite confident that eventually it'll happen to tech risk as well.
Michael, I think that's a good segue into the discussion about technology risk. And just to say that you were the chief technology officer, among other positions, for a bank with over $1 trillion in assets, just so that our viewers understand the size of that, which is, larger than most systems in many of the European Union countries, especially the smaller ones, obviously. Overall, in some of the exchanges that we've had prior to this discussion, you had talked about how important it is to modernize the business in addition to modernizing technology and to try and simplify things. How do you go about doing that, and how is that sort of part of your approach when coming to major technology and change management projects?
I think your question is really at the essence how to manage technology investments well, and how to use technology as really a major catalyst for business strategies. And maybe it's best if I just give you one example. So of course, public cloud has become a very important component in really all technology platforms at most organizations, whether they're banks, whether they are industrials, it doesn't really matter. Public cloud has become really important, and for good reason. But it's very easy to get excited from a tech perspective about all the benefits of public cloud, faster development, more scale, easy way to leverage the tech and the security investments that the large tech companies have made, better tooling, et cetera, et cetera. But if all you do is you take applications that used to be on-premise within the bank's data center and you move them to the cloud, and maybe they run a little bit better, maybe they run a little bit faster, and maybe they run a little bit more scalably, but you haven't really thought about how is the business evolving and what can it do today given I have better technology, then you've actually spent quite a bit of money with fairly limited benefit, because it's still the same application, which means it's still the same, well, as customer experience. It's still the same level of management information inside that you're getting. So the key is really, I think, a ongoing dialogue between technology leaders and business leaders, where our job as technologists is to kind of explain the world the way it is changing in technology, but also listen very, very carefully to what are really the key business strategies, the areas where a bank really wants to be different, really wants to win, and then double down and make sure that the tech strategy reflects business change in those areas. So I think that dialogue and that ability to use technology to simplify processes, create easier ways for customers to interact with the bank, take out operational cost, rethink how an end-to-end process works all together. I think that's really the opportunity, and that's where banks that manage technology well really differentiate themselves from others that still have more work to do.
That's interesting, and it leads me to think about the culture in a bank as an organization, how to deal with technology. Sometimes there are like islands of different professions in an organization, and given the specialization, of course, it needs to be that way. But how do you go about organizing, creating the conditions for a successful development of the organization, aligned to take in charge of the business opportunities, but also dealing with the risks? Do you have some thoughts on how to square that circle?
You know, one of the things that I learned over the last 10 years is probably that I came from a very entrepreneurial background, right? Algorithmics started with a handful of employees and ended up as a major technology player in the enterprise risk management space. And so, of course, we did that by moving really fast, by trying out new things, by having an excited dialogue with our clients at the leading edge of risk management. But that attitude that you just roll up your sleeves and get it done. First of all, it is important because that's how you change the world. But on the other hand, you have to understand how large organizations work, and you have to bring everybody along. And what I found is that actually spending sufficient time on topics like governance, who is accountable for what? Do we really understand who, quote unquote, owns technology? Especially in a large global organization where it's not just the business and technology, it's head office, it's regional offices, it's business, corporate functions and technology, et cetera, et cetera. So you have, by definition, many dimensions to an organizational matrix there, right? And then being very clear on who's on first, who ultimately has decision-making authority, and how does the whole strategy across these different dimensions come together. So that accountability dimension, I think, is super important, and it's also an area that regulators are increasingly focusing on. So that's one point. The second point, though, that I want to make is that it's also important to have a common understanding what we mean when we talk about key trends in technology and what we mean with key terms. And again, probably examples help. So let me come back to cloud, because I used cloud as an example already before. It's exciting to talk about cloud, and we can very quickly jump to the high-level benefits of cloud, and even I did that in 5 minutes ago in our conversation: scalability, et cetera, better tooling. But if I take a step back and I think about it, am I actually talking about public cloud like AWS, Azure, or Google Cloud? Am I talking about SaaS offerings, software as a service offerings? Or am I talking about cloud as infrastructure, just a better data center, versus cloud native using all the tools? And these have very different implications. For example, if I'm talking about SaaS, software as a service, what I need to do as a technology organization is actually much more third-party vendor management and third-party risk management than it is deep technology, because the software vendor, by definition, is doing it for me. If I'm talking about native cloud, where I'm using the latest cloud tools to build my own things in a public cloud, oh boy, do I really need strong technologists? And am I sure that I have those technologists? So definitions matter. That's the point of the example. And that's true for new technology, but I think that's also true for how you manage the business overall. So I was thinking of another example, and if you indulge me, I wouldn't mind sharing that as well. One of the common words or definitions that we always use is run the bank versus change the bank, right? And I think we're all trying in the industry to make sure that we manage run the bank spend very efficiently to free up enough money for investments, meaning change the bank. And that makes sense. And that's a good thing to do. But when you actually push and when you try to, again, think large enterprise with many, many bits and pieces, and when you try to say, well, do I actually really know, can I really define the boundary between run and change? It gets very squishy and very gray very quickly. And maybe as a simple example, if I build a new data center, that's capital investment and therefore probably change the bank. Now, in this day and age, in 2025, should a large bank build a new data center versus embracing public cloud? I would argue we should probably go towards public cloud. Well, but then it's no longer a capital expense. It's an operating expense because you pay the cloud provider every day, every month, whatever your pricing model is. And all of a sudden it's expense and not capital. And so most likely it shows up as run the bank. So it's a bit of a constructed example. And, I'm deliberately choosing the two extreme ends of the equation here. But the point is, if the organization hasn't defined and internalized the definitions of what we are talking about, then it's very easy to have a high-level strategic dialogue and get very excited, but you can't actually connect it to the specific actions and the specific outcomes and the specific performance metrics that demonstrate to you that you're actually making progress.
One very specific question in relation to technology, perhaps referring back to the development of Algo, is the possibility really to measure and automate controls that opens up. I think in the area of operational risk, technology risk, etc., monitoring cyber threats, etc., making sure that your systems are robust enough. Of course, the dream would be to have a much greater capability of measuring and also in an automated fashion control the risks. But how do you see that? I mean, on the one hand, it's a positive thing if it materializes. On the other hand, if you run around measuring all sorts of things, you have to connect it back to an enterprise risk perspective. So more measurements might not give better control. How do you see that?
The approach that it's first of all, it's a real challenge, and I don't think anyone has truly solved that challenge. And it's very easy, especially in a large organization, to end up with a ever-growing list of specific things that you're tracking, and you keep yourself very, very busy. And a lot of it's important, don't get me wrong, but you can keep yourself very, very busy, and you lose sight of what you're really trying to achieve. So how to solve for it? So the approach that I think that I've seen work quite well is to flip it around in a way and start with top-down scenarios, that tabletop exercises that help us understand what can really hurt our customers, what can really hurt the financial institution, and then basically work your way backwards and say, well, what would have to be true for that scenario to occur and for that scenario to create massive damage? And if you do that, then you have a much sharper focus on those risk metrics and those underlying control dimensions that you better pay a lot of attention to, because they are the difference between a little blip and a potentially very serious event. And so I think using that scenario technique, which frankly, again, I find we borrowed from financial risks, because I do recall from, when we built algorithmics and when we looked at how do we actually measure risks, one of the key focus areas was to take it beyond mathematical constructs like derivatives and things like that, and take it towards, well, let's define some extreme scenarios and let's see whether we have enough capital in that extreme financial market scenario. And if we don't, well, what can we do? What's our contingency plan to quickly raise capital? Can we have a better hedging strategy? So that was one of the major capabilities of the enterprise risk tools that we offered at the time. So when you fast forward now to 2025 and to technology risk, it's very much the same thing. It's what would happen for what would need to be true for a bank to have a very serious breach or to have a very serious outage, and then work your way backwards that way. And I think that helps us focus on a smaller set of key metrics, which we then better take very seriously and bring, again, remember I mentioned governance a little bit before, and make very clear who is accountable, what is the reporting mechanism from technology to the business, to the board, potentially to supervisors. And I think the reason I'm saying that explicitly, and the reason I'm bringing that up is I think in the old days when I started my career, technology was seen as something that just happens, right? And from a business perspective, if it works, it's great. If it doesn't work, the technology team has a problem. It doesn't really concern the business. That's the old way. But I think one message that I've at least heard in a North American context that has come through very consistently from regulators is that no. Business leaders have to be fully aware of the technology that they're using and of the risks how the risks around that technology are managed. And which brings us back to, well, how do you explain those risks to the business? Which brings us back to, well, if you can start with key scenarios and their impact, you have a much better chance to ultimately explain why certain metrics are important.
So, Michael, one of the main areas of risk, and obviously everybody listening to us today is a bank customer, is the area of fraud. How do you sort of see those main risks? We keep hearing of AI now coming in and recreating the voices of different people. There was a recent case, we're recording on the 10th of July, but a couple of days ago, the voice of the US Secretary of State, Marco Rubio, I guess, was replicated, and they tried to give instructions based on that. What should banks be thinking about when they implement technology, but especially with a view towards fraud management, given everything that's going on?
I think it's definitely one of the key risks. And my starting point would probably, in responding to your question, would probably be to say, well, banks, given how we've grown over time and given how banks have evolved over time, we almost by definition siloed organizations. And of course, every bank is doing a lot of work to bring silos together. But nevertheless, we have a branch, we have a contact center, we have digital, we have maybe a chatbot in this day and age. And fundamentally, many of the client interactions can happen in any of those channels, right? So you can call the contact center and ask for your account balance. You can go to your digital app and ask for your account balance. You can go to the branch, hopefully not, but you could go to the branch and ask for your account balance, et cetera, et cetera. Now, and these channels evolved over time. And now in the day of integrated data, in the days of AI, in the days of using AI for personalization, large organizations are trying to bring that data and those channels together for a consistent experience and for much deeper insights on the customer. But we are doing that reactively after the fact. When you look at criminal actors around us, they're not siloed. For them, it's very, very easy to jump across and to say, well, such and such a bank's digital security is pretty good. I don't really know how to get in, but let me try the contact center. Maybe they haven't updated their security protocol there in a few years. Oh, it's pretty good too. Well, let me go to a branch in a certain location where maybe they haven't trained the people properly yet, then I can get in. And whatever it is, once they're in one way, then it's easy for them to jump across to a different customer experience, And so I think before we even go to synthetic voices and all of that stuff, I would say the main thing that I would be looking at is, do financial institutions really understand how different experiences across different channels and across different activities, do they have like a common framework of how to manage fraud, or do they have like hidden nooks and crannies that the organization hasn't thought about in a long time that come back to haunt us. And so that to me is the starting point. What that leads to is some sort of a new integrated architecture, right? And many organizations have, for example, organizationally tried to bring fraud and cybersecurity together, sometimes successfully so, sometimes less successfully so, but it's just the organization layer. But I think underlying that, a much more component-oriented architecture where you have consistent controls that are in one place and not in many different places by channel gives you a much better chance to update and to reinvent. Because as a last point, the challenge is, when you run a global organization with technology in many parts of the organization, and you want to update a fraud prevention protocol, you want to update a security protocol, the more decentralized technology is, the more times you have to do the update. You have to go to this place and that place and that and that and that place. And first of all, it takes time, which is bad because, again, the bad actors can be much faster. Second, it costs money, which is also bad because you rather spend that money on doing something that really moves your strategy forward. And third, there's always a chance that you forget the last one that you really want to upgrade, and that's the weak point that the organization has. It's a long answer to a very short question, I know, but
could I just add to this point that I find really, really interesting? And one could wonder where the kind of center of gravity of problems lie. Where is that at? And I would be interested in your view to what extent identification and authentication is a kind of key area to address sufficiently. Now, with all the capabilities of interaction, you must know and be able to answer the question, who's there when you are doing a transaction? And so we made on Risk Matters just a podcast about the verifiable legal identity identifier as one example of trust services in a high-tech market. How do you see this area and the need to kind of improve things to address the types of crime we discussed?
I think it's a very important trend, and when in my recent role at Scotiabank, for example, I had the privilege to see how different countries address that at a national level, because Scotiabank is really focused on the Americas and has a significant presence in countries like Mexico, Peru, Chile, Colombia, of course, in addition to Canada, the home market, and the US from a wholesale perspective as well. But anyway, the point is that especially some of the South American countries have had government digital IDs for a long time, and that changes the way you build solutions, because it's very clear. There's a very clear way to know that it's really Klaus and it's really Arian, it's really Michael who is there with that government ID. Other jurisdictions, for example, Canada, doesn't yet have that, and so you can use a driver's license, you can use a passport, you can maybe use a health card, or so, and so on and so forth. So I think coming to a common digital ID is an important step, and it's something that goes beyond banking, that probably will impact many online services that we have. Having said that, it also creates a central point of failure, right? And in at least two ways. First of all, there has to be sufficient trust in government that the digital identification is managed for the right reasons, and second, that it's actually secure and that there is no way for the bad guys to get in there and essentially take all the IDs. But I think it's the less evil compared to many ad hoc solutions that try to identify in different ways, in different experiences where it's really you. And so I think it's a critical trend, and it's important for banks to be in the forefront of the trend, and potentially in some areas even offer solutions that go beyond the narrowly defined banking services to help identify essentially trusted customers.
Michael, let's move to our last question, which I hope is not sort of a little bit of a kind of sci-fi type thing, but how do you see the bank of the future? So, banking has obviously evolved from a branch network based model to apps to web banking and so forth. What potentially should clients and just bank consumers consider? What should they look forward to in sort of the next few years, in your opinion?
I think probably the starting point for in responding and answering the question is, fundamentally, I'm an optimist, right? And there's a lot of conversation out in the industry about challenger banks, neobanks, fintech, and are fintechs eating, the bank's lunch, for example, and so on and so forth, and can banks even compete? But when you take a step back, and I was just recently reading a study by BCG, for example, that basically says, okay, here and now and today, fintech and challenger banks together account for 3% of the financial services revenue pool. 3%, which means 97% is still large financial institutions. Now, a lot of what fintechs do is super exciting and really pushes the envelope of an outstanding user experience. But fundamentally, I would argue there are fairly low barriers of entry to banks to essentially follow down the path fairly quickly. We've seen that in digital, right? I mean, there was a time when there were some challenger banks that had awesome digital apps, and financial institutions had digital apps that frankly were not very good. But fast forward 5 years or 10 years or 7 years or something like that to here and now and today, I would argue that the majority of large financial institutions have digital apps that are as good as what fintechs offer. So that's one point, right? So where do banks fit in? But I really think probably the most significant development that we see now is around artificial intelligence and is around generative AI and large language models. And it will take time. That's this quote, and can never remember who said it. We always overestimate how much changes in 1 year, and we always underestimate how much changes in 10 years. So I don't think AI is going to change banking by this time next year in a fundamental way. But I do think that in the longer term, it will have a huge impact. Now, why? Because for a long time, the paradigm in banking was you have to pick your spot. You have to either be a low-cost commodity provider, or you have to be a specialized, personalized, high-value service provider where you can charge a higher price point for the more advanced services that you provide. But you can't be both. And for a long time, it was true that banks who tried to be both were in a tough strategic dilemma and were probably growing less quickly or less successfully than others that made clear strategic decisions whether to turn left or turn right. I think AI completely changes that, because AI allows us to personalize in an industrialized way. So we get the cost envelope of an industrialized, commoditized solution, but we get the client experience of a highly personalized segment of one type of experience. And again, it will take time to get there, because we need to do it at an enterprise level. And as we talked about before, enterprises are complex, and enterprises move at different speeds and have different constraints. But I have no doubt that we will get there. And when that happens, I think the inherent advantages in a banking business model, whether that's access to capital, whether that's a end-to-end understanding of what customers do through the entire life cycle of a transaction, or the entire lifespan of a personal customer, the many different services that they offer, all of that together actually puts banks in a very strong competitive position. So the door is open. Banks have to walk through that door, and some may stumble and some may not see the door. But as I said at the beginning here, I'm fundamentally an optimist, and I believe that technology, whether that's cloud, whether that's AI, or whether that's maybe in a next wave digital assets and smart contracts, will create an opportunity for banks to continue to get better and better in what they do for a long time to come, and be super competitive and frankly offer financial solutions and experiences to clients that make a difference.
Michael, thank you for that. And on that positive note, we can end it. I think this is good news for the consumers that their experience at a minimum will get better, at least according to your predictions. But thank you very much for this very insightful and interesting discussion.
Thank you. And again, Klaus, Ariane, huge thank you for having me on today's podcast. And I really appreciated the opportunity, and I thought we had a really good conversation. And thank you for the insightful questions that hopefully prompted meaningful responses. So have a wonderful day. And again, thanks.
Thank you.
Thank you.